SEBI's major announcements. Transforming India's stock market. In this video, we look at some of the recent changes announced by the Securities and Exchange Board of India (SEBI). These changes are set to significantly impact the stock market landscape, and whether you are an investor, trader, or just someone interested in the financial markets, you'll want to know about these updates. If you are watching our video on SEBI for the first time, and particularly for some of our international visitors who may not be aware, let's quickly recap what SEBI and its functions are. So, the Securities and Exchange Board of India (SEBI) serves as the regulatory authority responsible for overseeing and regulating India's securities market. SEBI plays a pivotal role in ensuring the fair and transparent functioning of the market through regulatory oversight, policy formulation, investor protection, market development, and educational initiatives. It regulates entities such as stock exchanges, brokers, merchant bankers, and other intermediaries to uphold standards of conduct and fairness, encompassing aspects like listing requirements, disclosures, and prevention of insider trading. SEBI's primary focus is protecting investors' interests by promoting transparency, combating fraudulent activities, and promptly addressing grievances. Additionally, SEBI drives market development by introducing reforms and new products aimed at enhancing market efficiency and liquidity. Through education initiatives, SEBI aims to enhance financial literacy and empower investors with knowledge about their rights and responsibilities. So if you are interested in learning more about SEBI, you'll find more videos on our channel covering various aspects of its role and impact on India's securities market. Number 1. Revamping the F and O segment. Let's start with the derivatives market, specifically futures and options, F and O. SEBI has decided to overhaul the eligibility criteria for stocks in the segment. Why is this important? The derivatives market is crucial for risk management and speculation, and ensuring that only the most liquid and actively traded stocks are included is vital for market stability and efficiency. SEBI has set up an expert group to examine three key areas: market development, investor protection, and risk management. The new eligibility criteria are designed to weed out stocks with consistently low turnover. Here are the main points. Stocks must be among the top 500 in terms of average daily market capitalization and traded value. The stock's median quarter sigma order size should be at least Rs 75 lakh. The market-wide position limit should not be less than Rs 1,500 crore. These changes aim to ensure that only the most significant and active stocks are included in the F and O segment, thereby improving market liquidity and reducing volatility. Number 2. Addressing the rise of influencers. Next, let's talk about the financial influencers or Finfluencers. With the rise of social media, we have seen a surge in individuals providing financial advice and making bold claims about investment opportunities. While some of these influencers are well-intentioned, many are unregulated and provide advice without proper credentials, leading to potential risks for investors. SEBI has taken firm stance on this issue. Brokers and mutual funds are now prohibited from using unregistered Finfluencers in their marketing campaigns. The rationale here is clear. SEBI wants to protect investors from misleading information and ensure that financial advice comes from qualified and regulated sources. This restriction, however, does not apply to those who are exclusively engaged in the investor education. This means that genuine educators who provide valuable knowledge without making specific investment recommendations can continue their work. If you are watching this video from outside India, please tell us the role of similar finance influencers and how they are regulated in your country in the comment section. Number 3. Introducing new delisting rules. SEBI has also introduced significant changes to the delisting process. for frequently traded shares. The new rules aim to simplify and streamline this process, making it easier for companies to delist their shares. Under the new framework, SEBI has introduced a fixed price process for delisting. This means that companies looking to delist must offer a fixed price with at least a 15% premium over the floor price. This change eliminates the need for the revised book building process, which can be difficult and time consuming. Additionally, there is a new delisting framework for investment and holding companies, IHCS. So you must be wondering what investment holding companies, IHCs, are. Investment holding companies, often referred to as holdcos, are entities that hold assets and securities of other listed companies, primarily with their own group. Unlike typical businesses, they don't engage directly in producing goods or services, but instead focus on managing investments. Their main purpose is to serve as a strategic vehicle for owning and overseeing subsidiary companies. Some IHCs may provide operational support to their subsidiaries, while others concentrate solely on asset management. These companies come in various forms, such as private equity firms or publicly traded corporations, catering to investors looking to pool funds for specific investment strategies like real estate ventures or industry-focused portfolios. Ultimately, IHCs are all about maximizing investor returns through savvy asset management and strategic capital allocation. This new framework allows IHCs to transfer their underlying equity shares to public shareholders proportionately during delisting. This provides greater flexibility and clarity for both the companies and their shareholders. These new delisting rules really depend on a few key things: how the market's doing, what the company is worth, and how investors feel about the whole deal. Experts are also watching closely now that the counter offer thresholds been dropped from 90% to 75%. However, whether shareholders accept these offers will still depend on their confidence in the company's future and how the market behaves. Overall, these regulatory updates are anticipated to stimulate more mergers and acquisitions (M&A) activity by making it easier for companies to consolidate ownerships and make strategic decisions, potentially reshaping the corporate landscape in the process. We are getting mixed reviews from the public shareholders regarding the new rules. Number 4. Easing rules for foreign investors. In an effort to attract more foreign investment, SEBI has eased regulations for foreign portfolio investors. University funds and related endowments classified as Category 1 FPIs are now exempt from additional disclosure requirements. This move is designed to streamline the investment process and make it easier for these institutions to invest in the Indian market. By reducing the regulatory burden on these investors, SEBI hopes to encourage more foreign capital inflow, which can provide additional liquidity and stability to the market. Number 5. Increasing flexibility for AIFs. Alternative investment funds, AIFs, are a specialized category offering unique investment opportunities in India. AIFs are private pool funds regulated under SEBI's guidelines with flexible structures like companies, LLPs, or trusts. SEBI classifies AIFs into 3 main categories. Category 1 includes venture capital funds for startup and SMEs, angel funds for early stage investments, infrastructure funds in construction, and social venture funds for socially responsible ventures. Category 2 covers private equity funds in unlisted companies and debt funds in high growth debt securities. Category 3 features PI funds in public company shares, and hedge funds with aggressive global investment strategies, though they come with higher fee. Now, alternative investment funds, AIFs, are also receiving more operational flexibility under the new rules, Category 1 and 2. AIFs can now borrow for up to 30 days to cover short-term investment needs. This change is designed to help AIFs manage their cash flow more effectively. This new flexibility is crucial for AIFs as it allows them to meet temporary shortfalls in drawdowns from investors while making investments. By having the ability to borrow for short periods, AIFs can ensure they have the necessary liquidity to seize investment opportunities as they arise. Number 6. Removing penalties for technical glitches. Finally, SEBI is making a significant change in how it handles technical glitches. Previously, the Managing Director and Chief Technology Officer of exchanges and market infrastructure institutions faced financial penalties in the event of a technical glitch. SEBI has now removed these penalties. This change is intended to create a more supportive environment for managing technical issues. Technical glitches are often unavoidable in today's digital trading environment, and removing these penalties aims to encourage a focus on resolution and improvement rather than punitive measures. So, in a summary, SEBI is implementing substantial changes aimed at tightening regulations, protecting investors, and streamlining market operations. These reforms are expected to bring increased stability, transparency, and efficiency to the Indian stock market. Thank you so much for watching. If you found this information helpful, please like and subscribe and hit the notification bell for more updates on the latest in finance and investing. Stay informed and stay ahead. See you next time.